Our next guest has warned of the four horsemen of the apocalypse visiting us, economically speaking, of course. First, there was a plague, then war. What's next? Michael Gayed is back. He is a portfolio manager of Toroso Investments, and the theme of our discussion is Phoenix Rising. What exactly is this Phoenix? What is rising? And what are these ashes that we're rising from? Michael, welcome back.
Yeah, no, I appreciate it. So, and hopefully death, which is the fourth of the horsemen, does not come. But when I refer to Phoenix Rising, every now and then I'll put like a Giphy on Twitter with a picture of a phoenix, all fired up. What I'm really referring to is treasuries, the behavior in particular of treasuries when you're in a volatile stock market period. The frustration for me as somebody who runs these three funds you see in the background, that's risk on, risk off, and everything that I do, has been that in the first 6 months of the year, looking at stocks and looking at long duration treasuries basically made you see the same thing. In other words, stocks and treasuries acted all very similar in terms of the drawdown. Historically, when you look at the top 50 drawdowns for the S&P, the peak to trough percentages, in those top 50 drawdowns, treasuries tend to act as the safe haven risk off play in the midst of that stock market drawdown. So first 6 months of the year, you ended up having the exact opposite. Treasuries ended up selling off as hard, if not harder, than the broader stock market. So you have this situation where if you pull up that chart on the drawdowns, you'll see very clearly one of these pairs is not like the other. So I've argued that this has been the anomaly. And in terms of this idea of the Phoenix Rising, what I'm really referring to is that if you were to have another wave lower in equities, which I think is likely to come, that treasuries go back to the way they historically behave as the risk off, quote unquote, safe haven, where money goes into the long duration side, yields drop, and you can actually make money then during that more classic risk off environment for equities. We haven't seen it this year, which again largely explains the drawdowns I myself have gone through with all my own strategies. But at the end of the day, if things normalize somewhat, then there's going to be an opportunity to make money, and by diversifying into U.S. government debt.
Okay. I want to come back to a number of things, but let's talk about treasuries for a minute here. So short duration, long duration, what do you prefer right now? I mean, keep in mind, rates are rising.
Yeah, but on what part of the curve? So this is why this is such a nuanced conversation. I would argue that what happened in the first 6 months of the year was not justified, which is not a very popular opinion, this idea that bonds fall and yields rise. It's not that it's not justified in terms of the two asset classes, bonds and stocks, treasuries in particular, selling off with equities. It's the way in which it happened. It's that sequence of returns in the midst of that stock market volatility. So you had this everything bubble burst, right? We had this everything rally, everything bubble, then everything kind of collapsed. Commodities, we'll talk about in a bit as a differentiator. And then if you notice June 16th, intraday, that's when both treasuries bottomed, meaning yields topped. And on the same day, June 16th, was when small caps bottomed. And since then, you've had an everything relief rally since really mid-June. The weekend after that low, I said, I think last week was probably the low for stocks and bonds and probably the low for cryptocurrencies. So it makes sense. Everything sell off, then everything relief rally. But for things to really normalize, you then have to have divergence. Divergence meaning where treasuries keep on rallying, yields keep dropping on the long duration side. The Fed keep on raising the short end, but the long end is really what I'm referring to. Yeah. And then stocks diverging from treasuries in that, which would be more classic risk off, would be your next wave lower for, potentially lower lows in equities.
Okay, so all right, let's talk about lower lows in equities then. We've already had 2 quarters of consecutive GDP, technically a recession. That's to be debated by the authorities. But technically a recession. We have the Fed raising rates by 75 basis points, the most they've done in many years. As we speak today, the Bank of England just raised rates for the first time, or not for the first time, but the highest amount in 27 years. So rising rates are happening all over the world. The markets have already priced in this. That might be one argument that you could make. So why could we go even lower from here? All the bad news that we've already seen has already been priced in. Would you disagree with that?
Yes, because what has not been priced in is a real housing recession. So the remarkable aspect about the way this is played out, and this is what you and I were talking about back in February and March when I said, your home is about to be worth less. I was saying that because lumber prices were starting to reverse, and lumber is a much better way of telling you what's going to happen.
It is a dangerous play on words, because when you say it quickly, it sounds like worthless.
Worthless or
is
worthless?
It worth less or worthless? Is a very big difference here.
I've had that on Twitter. People say to me, "What do you mean worthless?" And it's like worth less. I put a space in between it. But hold on. But my point with that is that this move that happened again in the first 6 months of the year, which has been an anomaly, and I can prove that with all kinds of data on my Twitter feed, on the lead lag report.
Yeah.
But you had this very fast and aggressive sharp sell-off in stocks and bonds, and again, stocks and treasuries, which has been the real problem. But you haven't really seen that in housing just yet. Housing is only now starting to roll over. So my contention is, if things quote unquote normalize, whatever that word means, I know that's a loaded term. Yes. Well, then if you were to have another disinflation scare, that should be driven by home prices breaking down. And that would be another sort of real big headwind against the bulls, because you have not really seen that weakness in property prices. It was just getting started.
Okay, so we've had a drawdown in cryptos and stocks. You think there's going to be a more of a drawdown in stocks? Let's finish up on this segment, on this asset class, and then we'll move on to housing. So how much further on the downside do we have for stocks?
I mean, the truth is, I don't know, like everybody else, but I mean, if you look at history, right, if it's a bear market, yeah, you can go down easily another 15, 20% from here. I don't see why that's a shocking statement. You know, if you're in a true bear markets end up going lower than you think they will, right? And they end up lasting longer than you think they will. So, you know, unless you believe the bear market is over, you know, you treat this rally as one of those classic standard relief rallies, which was long overdue. And it is funny, by the way, that seemingly now everyone is bullish after such a big move off the lows in from June.
Right.
You know, it seems almost too obvious to know where the crowd's sentiment is most extreme, and we went from one extreme to the other very quickly, from bearish to bullish.
In 2008, I think the stock markets, the S&P 500, correct me wrong, but I think it went down about 50% throughout the recession. But that's from the start of the recession till the end. Keep in mind, let's assume we're in a recession. Let's assume the 2 quarters of negative GDP growth can be defined as a recession. Well, the stock markets have already been falling since the beginning of that period, which was since Q1. So as of last year, basically as of the end of last year. So we're already down, 20 something percent on the S&P 500. So that implies another 20, 30% from here. If you assume that will fall to the same levels as 2008, yeah.
Yeah, I mean, and who knows if it's going to be like 2008? You never know. If there's, you know, environments like this can be tricky, because there could be one of the events that comes out of nowhere, nobody sees it coming, kind of classic black swan argument. But again, I go back to magnitude. The thing is, when you have so much leverage in the system, it's very easy to have a very big tail event on equities, right? And so that, I think, is the sort of the real dilemma. And I think from a longer term perspective, people are underappreciating these lags in terms of what we're seeing with ag prices, with commodities, and then it being filtered into the actual economy. And then consumers suddenly realizing that, who are not in our field, not aware of these things, saying, well, now I have to change my behavior, right? So this is going to be a very, I think, messy process to really unwind this from a longer term perspective. But again, you know, here we're talking about endpoints. As a portfolio manager, I care about the sequence of returns. For me, the Phoenix Rising is the sequence of returns favoring treasuries again.
I do want to ask you about rotation back into equities. Now, there's one thing to anticipate a downturn. It's another thing to recognize when things are inflecting and when things are starting to look up again. Now, there was this table I brought up a while ago to another guest. I'll bring it up here. And it shows that basically in prior recessions, the stock markets typically start rebounding before the GDP starts to recover. In other words, when GDP has troughed, that's when you should be getting in, because by the time GDP starts posting positive numbers again, you've already missed out on double-digit gains.
Sure.
So I guess the question is, again, nobody has a crystal ball. Timing the markets is hard, but I guess the question is, how long can this recession last? And if you assume that history repeats itself, answering that question would give you an indicator as to when to get back into the markets.
Well, but it's interesting, though, because you mentioned GDP, but if you look at building permits are really what have to trough in order for you to be ahead of a recession. I've put out all kinds of data, which again relates to how important housing is to the economy and goes back to lumber at the end of the day, which is what my Roto ETF uses as a signal. But my point is that this is sort of the dilemma. We're very desync, right? A lot of these asset classes are very desync from each other in terms of housing, commodities versus stocks and bonds. So you've got to kind of get these things to historically, again, respond off of each other's movements. So housing, building permit, all this stuff has barely started to really show any signs of deterioration. So until that really troughs, if we are indeed in a recession, which we can debate the definitions for here to tomorrow, I happen to think we have been for a while here. Well, then if that's the case, then sure, you should see more pain to come until housing, real estate in general, goes through its own flush. And honestly, that's the real way to break inflation. First, you do it with the stock market, which affects a relatively small percentage of the population, but the only real way to break inflation is to do it across the board in most people's primary asset, which is their homes.
Housing doesn't always lag the stock markets, right? If I remember my history correctly, 2008 was kind of the reverse. The stock market started crashing after the Lehman collapse, which happened because the housing markets cracked first, right?
Right. So the housing peaked in 06, and then it was 2 years later, right, when you saw the after effects. And that's an important point too. There can be these long lags, right? Sometimes, and that's just an example, an n equals 1, a sample size of 1. But usually housing would be the first sort of real big warning sign of some kind of disinflation or deflation pulse.
So what are the warning signs you're seeing right now in the housing market? You mentioned that we're about to see a correction.
Yeah, I mean, look, I get all the arguments around supply and inventory, but we clearly saw that this spike in 30-year mortgage rates caused the entire housing market to stall very quickly, and now obviously yields have come back in. Again, another reason why risk on, risk off dynamics should come back, where Treasuries actually work, would be housing decelerating, because that means 30-year mortgage rates then to a slowdown, right? So it's all connected from that perspective. But look, home affordability is stupid at this point. I mean, it doesn't matter where you are, whether you're in Canada, God bless you, because I don't know how you can afford anything there, right? With home prices the way they are. So my entire point with this is that you have to break this affordability issue. You have to really result in forced sales of homes, second homes, third homes, homes as investment properties. That's probably where this longer term flushes out, because that's where also a lot of the speculative money has gone into.
It is interesting how you mentioned home affordability. So yeah, I was looking at the median home price to income ratio. Right now, we're currently at 8. The ratio is at 8. This is put in perspective. This is higher than 2008 when we had the housing bubble in 2008. That wasn't as high as what we have now. So yes, you're right. It is an affordability issue. Homes have never been this unaffordable. Now, another way this problem could be fixed is, let's say, if home prices just stay flat and then nominal wages just eventually catch up. Is that a scenario?
I mean, no. And I say that because, your real income has been negative with all this inflation, and the real inflation is obviously higher than what we're being told from CPI. So it's like income will never catch up to that. You have to the heavy lifting has to come from the home side, not from the income side. You're not going to see that with income.
Well, okay. So in order for homes to fall, they have to be sold. Are you seeing that right now? Are people selling en masse?
No. So this is why this is going to be very different than the 06-08 period, because the reality is a lot of people are not going to sell, because where else are they going to go, right? So in other words, the supply keeps on staying relatively muted, but this is where the demand starts to really break down. And keep in mind, we've seen these comparisons of look at how mortgage payments have increased and how much they've increased per month. So if that, let's say, stays stable, okay, while people now start to realize I got to make decisions based on food prices, based on the coming winter and home heating bills, which are going to go through the roof, you're going to have a real issue in terms of what do you do with your mortgage payments, and that might then cause some forced selling. Right. But to your point, this is still very, very early. We haven't seen really this unwind just yet, which I think is why you still have another major wave lower and more classic risk off to come.
Well, home prices could go lower from two forces. One, selling, which you just talked about, or another one, which is a slowdown in purchases, basically a slowdown in demand. Okay, let's talk about both. So selling, I can understand your argument. If you sell, where else are you going to go? Well, I mean, there's a lot of supply where I live. In Montreal, for example, and all over Canada, they're building new condos. Those are expensive. The new condos are expensive. So it's not like I'm selling one for a loss and then, buying something else more expensive. I don't think people are going to do that. But let's talk about demand. So yeah, things are slowing down. What's going to come first? Demand slowdown or a housing price correction? Which is going to come first? Chicken and egg problem, hey, isn't it?
Yeah, partially. I think, look, I know you saw this. There's a TikTok video, not that I'm on TikTok, but it's making the rounds on Twitter, of a farmer basically saying, be very aware that what's coming in terms of food prices is very substantial, and people are going to be shocked in the way it occurs.
Yes.
And the video was this farmer basically saying that, consider that, your meat for next year is only coming into this earth now, right? Their calves, their baby, animals from that perspective. and so, which means they're getting fed this much more expensive hay and all the things that go into the feeding, right, to get to the food supply ultimately. So there's this lag, which people don't realize is out there, which means that when the average person who's not in financial markets starts realizing that their food prices are going up much faster than they ever thought, and again, the home heating bills, that's going to break demand because it forces choice between getting a house, dealing with a high mortgage payment, or actually paying for basic needs, right? I think that dynamic is still very much in play.
Yeah, let's talk about that. Last time you brought up a very interesting point, which is that if food prices rise to a point of becoming unaffordable, people are going to have to make a choice, either pay for my milk or pay for my mortgage. And, we know what that's going to be. Could it get that bad though? Let's take a look at the numbers here. The food and the FAO index from the United Nations. That food index has actually come down. It's been trickling down over the last 3 months. So we've seen a peak in food prices. Is that a number that kind of calms your nerves, so to speak? Are you does that calm your jitters when it comes to?
No, sure. No, and to your point, I've made that point too. It's like, you look at corn, soybeans, a lot of these staples, these commodities have gone round trip in terms of giving back their war premium, right, with Russia going into Ukraine. But these are areas which are still very elevated. And if you get any kind of a bad weather event or anything else, right, if Mother Nature decides to suddenly step in an aggressive way, then you can still have other shocks. That's the thing about with commodities, which I think is interesting. You are more likely to have a positive shock, meaning something that makes commodity prices more expensive because of supply shocks, than you are to have a negative shock. Whereas in the stock market, you're more likely to have a negative shock, meaning a big down, as opposed to a positive shock. The tails are in different parts of the asset class spectrum there.
Okay. Let's circle back to housing and end it there. On housing, that is. So is this the first time we've seen a major real estate correction since 2008? Because after that, as I recall, it's just been a nonstop bull market for on average, right? Obviously, different jurisdictions have different cycles and whatnot. But
yeah, I mean, as I recall, there was kind of a sideways period for a good amount, and then right like that. But the what I would argue here is that you have a global phenomenon where the ability to live in your house or the ability to have a house to begin with is so obscenely impossible to try to achieve if you're the next generation, right? Relative to incomes and relative to the environment that you're in. So if you don't have that demand, and if you have baby boomers living longer so that you don't actually cause forced sales from an estate, well, then that is a substantial issue for any and every economy, right? You have very different dynamics in 06, 08, but I would argue the similarity is that you have to bring these prices down. Otherwise, you're going to have societal unrest. You're going to have heightened inflation, and it's going to be a very frustrating environment for everybody.
I just talked to a buddy of mine who closed on a condo sale. He actually sold above bid, but this was a few months ago. Things might be slowing down. Again, nobody has a crystal ball, but just put on your speculator's hat. How far could we go in terms of a correction in the housing market?
So I think the most important aspect of any kind of correction is not necessarily magnitude at this point, but the length of time with which it takes place. So I would argue that housing it would probably be frustrating because it likely grinds lower as opposed to having sort of very, very big drop. And I say that because you do have institutions, right, that are at the margin holding these properties that are not necessarily going to be for sellers, and price is always set by the marginal seller. So that might kind of drag the sort of weakness on for a while, which is why I still very much am of the opinion that you have a disinflation, deflation kind of environment to come still.
Yeah.
But who knows on the magnitude, right? I mean, you have to. I'd have to go look. I mean, if you pull up that chart, we can probably look at what the historical ratio of that household to income level is. But you probably have to get that back into some kind of historical baseline average. The thing is, though, whatever that baseline average is, you probably have to also go past it, because I always make this point that mean reversion means you have to go past the mean. You have to overshoot.
It almost seems like this is a self-fulfilling prophecy. The more we talk about it, the more people want to sell. And then so it begins. Let's stop talking about it right now, Michael. Let's move on. Let's talk about, I want to talk about inflation. That's very important. But first, I want to come back to a tweet which ties into the housing market. This is a tweet you made a while ago. The most predictive sector of the stock market is utilities. You said the most predictive commodity of the stock market is lumber. Both have to do with your home. Both have to do with leverage. Both have to do with risk off before it's too late. Few understand this.
Yeah.
Okay, so tell us what you mean by that, and then we can talk about your lumber to gold ratio.
Yeah. So I mean, so it relates to these research studies. I know people are going to roll their eyes when I say my 5 award-winning white paper since 2014, but I am
I mean,
proud
it's
of that work.
important, yeah. I mean,
Yeah,
sure.
but yeah, and that's available on if anybody's curious on the Social Science Research Network. It's not my opinion; it's quant-based, research-based. So historically, utilities, the most boring sector of the stock market, tends to outperform in advance of high volatility events for the broader stock market. Why is that? Going back to 1926, why is it that utilities tend to lead in advance of a major crash, correction, bear market? Because utilities are the most bond-like sector of the stock market, right? Usually, when utilities are outperforming, that's not just defensiveness; that's a bet that rates are going to fall. This year has been very abnormal, by the way, because oddly enough, utilities have acted risk off in the first 6 months, massively outperforming. But again, Treasuries did not act like they historically do as the risk off safe haven, which I've called many times my hell. But utilities, factually, when they outperform in these short term bursts, more often than not, that tends to precede major declines for equities. So it's a highly leveraged sector in terms of maintaining the grid, in terms of earnings variability. It's more driven by interest expense, not so much by demand, because utilities cannot raise prices month over month. Lumber, we talked about, the link is around housing. I can't tell you how many people have said to me, I don't understand the link. They tweet at me, I don't understand the link of lumber. Why do you talk about lumber so much? I'm tired of seeing tweets about lumber. Meanwhile, they're tweeting from their home. Average home has 16,000 board feet of lumber. That relates to another paper that won the 2015 Founders Award. I use the lumber to gold relationship in my Rotary ETF. I use the utilities relationship in my JoJo ETF, junk on, junk off. Typically, in major declines, the two will tell you the same thing in advance, meaning prior to major declines in equities, again, not my opinion, you'll see utilities outperforming the broader stock market. You'll see lumber weak relative to gold. We're pretty much at that point now. Now, it doesn't mean it's guaranteed, but this is a point now where the signals are kind of synced up.
So let's take a look at this. All right, you sent me a chart of lumber to gold ratio, very important now. I see it's at the same level as 2021. Now remember, the lumber to gold ratio spiked in early 2022, and then that's because the lumber price spiked, and then of course we know the lumber price came all the way back down, wiped out all of its gains from this year, and now it's back to the same level as 2021. Okay, correct me if I'm wrong, but the stock markets didn't have a dramatic correction in the middle of 2021. That started later on in the year, but it was a leading indicator in the sense that we saw the lumber to gold ratio kind of fall down, and then a couple months later, lo and behold, stock market correction. But now it's back to the same level. What does that imply?
Yeah, and it's not so much in terms of the research. It's not so much about the level, but the rate of change. So
the rate of change.
So it's interesting, right? Because in this move higher off the lows, going back to the June 16th bottom for small caps and treasuries, it makes sense that treasuries would rally, that yields would drop on the long duration side as lumber relative to gold is weak, because it would suggest housing demand is slowing. Again, so mortgage rates should drop to reflect that, right? And we've seen that. It's not common to see lumber so weak while the stock market itself is rallying, which is why I think this is more of a sucker's rally than not, right? To see that kind of divergence where lumber is weak while stocks are going higher. I'm not saying that doesn't happen. I would simply argue that this is not one of those periods where I think it suggests the stock market is right. Right? Again, going back to housing has a long way to catch down to everything else. So, and again, looking at utilities, which have been strong for a while, right? Utilities are telling you the same message, and now treasuries, because they've been strengthening the long end, are all telling you, essentially the same message. You're probably in a risk-off condition now. Again, that doesn't mean that you have to crash, but typically when you have a crash in the stock market, or at least a major decline, these areas tend to warn in advance. Again, it's not my opinion. This is just the way the research, bears it out.
Well, we've been in a bear market for basically 7 months. Obviously, the last month was actually kind of bullish. That the last month was positive for stocks. But you're saying that basically what the charts and the indicators show you is that we're not out of the bear market yet, and we've already talked about how far it could go earlier. So, all right, I guess the indicators line up with your thesis here. Let's talk about inflation now. I want to bring up a tweet that you recently made. By recently, I mean yesterday on the 3rd of August. You said that from inflation shock to deflation pulse. That's all you wrote. Sometimes your tweets are very cryptic.
I have a little vodka, and I said, all right, just kind of stream of coffee.
But it is true that if I'm looking at the prior recessionary periods, pretty much almost every time we've had a recession in the past, inflation tends to fall. The CPI tends to start to decline, and the rate of inflation tends to fall. Is this going to happen this time around? The only reason I ask you this is because up until a few months ago, pretty much everyone was talking to me about stagflation. That was the theme.
I hate narratives, man. And anybody that's tracked me on Twitter knows that I am the most cynical guy. I had said, early July, I put a tweet saying, watch how quickly the narrative changes. And just as everyone was afraid of recession, now on financial media, suddenly, we might not have a recession. Narrative follows price. Narrative is nonsense, right? And again, that's a little bit of a contradiction because I'm giving a narrative myself, but I'm trying to attack sort of the popular narratives, right? So, for those that are cynical on my cynicism, I understand the cynicism. Okay, now the on this point about narratives, suddenly everyone's bullish. Suddenly people think the recession is not going to happen. Probably the fact that now people are saying that probably tells the recession still happens, right? So my entire point with this is that again, you can see how quickly the stories change, and you can probably fade those stories because most often stories are fictional.
Okay. Please continue with that thought.
Okay, I'm doing the dramatic pause for a second.
All right.
So when you think about the way you've had this fairly sizable rally off of the lows, it's not because, and this is one of those narratives I think is important to dissect. It's not because suddenly the Fed is pivoting. It's like I can't stand it when people say the Fed has inflation under control. This is nonsense. Oil has inflation under control. Okay, because there's a very, very tight link between oil price movement and inflation expectations, inflation break-evens. Again, not my opinion. So oil topped pretty much a week before that June 16th low. Energy stocks topped pretty much a week before that June 16th low for small caps and treasuries. So as long as oil and then obviously the other commodities keep on staying, in somewhat of a downtrend, which is what you typically see, by the way, in a recession after a big advance. That inflation scare suddenly becomes a deflation shock, or the inflation shock becomes a deflation pulse, right? Which again would argue treasuries as the risk-off safe haven, would argue houses break down. If you go from this narrative switch from everyone's worried about hyperinflation to now cutting off the hyperinflation tail risk, and now everyone's saying now we got to be worried about debt, recession, and disinflation, not hyperinflation, right? That's how you end up having another wave lower. But the story for that only is going to happen after the wave lower has taken place.
I bring it up because people have been telling me, okay, well, we're going to get possibly a recession. This was a few months ago. We're going to get a recession, if not already in a recession. But I still think prices are going to stay elevated. I think inflation is going to stay elevated. I think a lot of people watching the show would agree with that narrative as well. But you can't really have it both ways, right? If you look at the data, in prior recessions, inflation has come down. So unless you're telling me this time it's going to be an exception, please explain why it's going to be an exception and why we're going to have a recession and an inflation.
Yeah, no, so I have never bought the stagflation argument from day one because you can't have stagflation when debt is as elevated as it is. We got $30 trillion of government debt and then never mind the unfunded liabilities. The system can't work if you have collapsing equity prices and collapsing bonds, rising yields, because your tax revenue collapses with that as capital gains evaporate, and now your interest expense has increased substantially when you roll over the debt. So if you go the stagflation argument, basically is an end of the world situation because it means deficits explode from an already levered state. So you're not in an environment where you're going to be in the middle, right? You're going to have an extreme. The extreme is either going to be hyperinflation or deflation. The idea of a Goldilocks in the middle thing to me just doesn't make sense when you have so much leverage.
Okay, so all right, what is your view on inflation then? Are we going to stay peaked around 9%? Are we going to stay elevated? It's going to come down a little bit. I've heard a view that we're going to come down to 4% next year. The Fed certainly thinks we're going to come back down towards 2% at some point. Where do you fall on the spectrum?
When you said the Fed thinks, I said the Fed thinks. Yeah, just separate. All right, no, and by the way, it's not me being anti-Fed. It's just
you're allowed to express your opinions on the show. We're here to get your opinions.
Anybody that thinks they know the future, I think they are wrong. Flat out, right? So, and that includes myself, right? We have to talk in terms of conditions, probabilities, and outcomes in the context of that. But anybody that thinks that the Fed knows what's going to happen next has no goddamn clue and should look at what the Fed's history of prior forecasts is. It's atrocious, right? So, okay. So my point with this on inflation is, look, peak inflation probably did take place as long as oil stays low.
Okay.
If oil suddenly makes a comeback, and a lot of people are making very compelling arguments, look at supply, look at other sort of patterns and underinvestment. I don't disagree with any of that, right? But as long as oil stays low, then inflation probably, or at least trends lower and kind of finds a a higher average, but is not too far above its average, yeah, that probably means inflation peak. But inflation peaking, to your point, could still mean 4 or 5% inflation, and that's still going to be a real problem societally, right? And again, if you have very high inflation now, that means you have to have disinflation, deflation later, which is why the long duration side of the Treasury curve is responding with lower yields as the Fed is hiking rates. So yes, if you're going to force a real disinflation, deflation type of period to break this elevated inflation, yes, you have to have a recession. You have to kill off demand, and you have to make suppliers suddenly start worrying about competition.
Okay. Interesting. All right. Good points. Let's tie everything together now. Investment implications, given everything we've discussed, given your outlook on the markets. What should you buy? What should you sell?
The world is ending. That's all I know. No.
Well,
okay.
I mean, it is ending at some point. I mean, you're right. In a couple billion years, this planet will cease to exist, but we won't be here to see that day.
And
so
neither will
your statement is technically correct. It's just not happening right now.
No, you're right. It's funny. You can always be right on a long enough time frame, right? things always happen, right? No, but hold on. So let's talk about implications. Okay. So again, the hell for me, the first 6 months of this year has been this idea that treasuries have acted like equities, that risk off acted risk on, that no matter how you rotate, no matter how you diversify, you pretty much were screwed either way, right? They acted the same, the drawdowns were doing, and that top 50 drawdowns chart, I hope you show it, that really is going to emphasize that point. So that's the anomaly. Okay, so let's say things normalize. Then most likely you want to consider things like treasuries, because even though they didn't act as the safe haven risk off, the truth is, it's not my opinion, more often than not, in real high volatility periods for equities, treasuries, at least for a moment in time, tend to do well, kind of like gold, kind of like the dollar, the risk off assets. I have these three funds, Roro, ATAX, and JoJo. They've all gone through a nasty drawdown. I'm very open about this. I talk about this all the time in media appearances. Why have they all gone through a nasty drawdown, all doing a rules-based rotation approach with different signals? Because they all have the same commonality. Treasuries are the risk-off play, right? So if you go with me that this you probably are in a recession where the recession is still early and that the housing decline is probably still early and that this is not over. What we saw since June is just a standard bear market relief rally. If I'm right on that, and the Phoenix rises where treasuries act as the risk-off safe haven, that means for a portfolio, you want to actually start betting on diversifiers working again. Diversifiers meaning, again, treasuries, gold, and the dollar. The dollar's already been working. And by the way, that's a conversation maybe for another day. I have to tell you, the way the dollar has acted this year, it's almost like it's sensing some kind of sovereign debt crisis.
Okay. You always leave me on these cliffhangers, and I have to follow up.
That's how I end up coming back on the show. You know that.
Okay. Next time, we're going to talk about the sovereign debt crisis. All right. Episode 2 coming up. Stay tuned. This is how the TV shows get you. Yeah, after this very long break. But we will have you back on soon to talk about that subject and more market moves, of course. Hopefully nothing blows up around the Taiwan-China area before we talk next time, but that is another area of concern. Anyway, thank you for coming on today. Michael, I appreciate your thoughts as always.
I appreciate you, and please just tell me who does your hair, because I gotta do something about this hairline.
That is a privileged information. I can't share that with anybody. Maybe offline.
You understand this, my friend. You understand.
You understand. Thank you again, and thank you for watching Kitco News. I'm David Lin.